Welcome to this explainer from fffinstill. Today we're going to pull back the curtain on the single most important economic report that sends shockwaves through the market month after month.
So let me just kick things off with a question for you. If you had to bet on one single report, just one, that consistently moves the stock market more than any other, what would you pick? GDP? Inflation data? A Fed meeting? Well, the answer, believe it or not, is the U.S. jobs report. It lands like clockwork on the first Friday of every single month, right at 8:30 a.m. Eastern. And let me tell you, this one report can absolutely set the tone for the entire market, for the day, the week, and sometimes even the whole month.
Now, its official name is the Employment Situation Summary, and it's put together by the Bureau of Labor Statistics. But here's the really interesting part. It's not actually one report. It's two completely different surveys mashed together, which gives us this incredible health check on the U.S. economy.
See, on one hand, you've got the massive establishment survey. They talked to almost 700,000 businesses to get that famous payrolls number. But on the other hand, you have the household survey. They call up 60,000 regular homes to figure out the unemployment rate. And because they're measuring two different things, well, sometimes they tell two very different stories. That's exactly why you have to look past the big, flashy headlines.
All right, so let's cut through all that noise. Inside this really dense report, there are only three numbers that you, as an investor, really need to care about, the ones that actually move the needle. Let's break them down.
First up, the heavyweight champion, Nonfarm Payrolls, or NFP for short. This is the big one. This is the number that everyone on Wall Street holds their breath for. It's simply the net number of jobs added or lost in the economy.
So to make this real, let's look at an example. The number for March 2026 was a gain of 178,000 jobs. On the surface, that looks pretty decent, right? But here's the thing. The actual number isn't what really matters.
The crucial concept here, and you gotta get this, is this surprise. The market reacts to the surprise. So a gain of 200,000 jobs can actually be a bad thing for stocks if all the experts were expecting 250,000. It's all about what actually happened versus what the market had already priced in.
And just to make it more fun, it gets even more complicated. The BLS also goes back and revises the numbers for the last 2 months. You can have a fantastic headline number that gets completely wiped out by negative revisions, and that can cause the market's initial reaction to do a complete 180.
Okay, let's move on to the second key metric, the unemployment rate. Now this is the one that gets all the love from the media.
For that same month, March 2026, the unemployment rate came in at 4.3%. And again, on the surface, that sounds great, a low, healthy number. But you have to be so careful with this one.
You see, the rate only counts people who are actively looking for a job. So yeah, a drop could mean more people got hired, which is fantastic, or it could mean that a bunch of people just got discouraged and completely gave up looking for work. And that's a huge sign of weakness. It just goes to show you why the context is everything.
This number also powers a really popular recession indicator called the SAM rule. Basically, it triggers if the 3-month average unemployment rate climbs 0.5% above its low for the past year. Right now, that trigger is 4.6%. We're at 4.3%. So we've got a little bit of cushion, but it's something the pros are watching like a hawk.
And that brings us to our third, and maybe the most underrated, market-moving number of them all, average hourly earnings. This is all about how much our paychecks are growing.
Think of this number as a direct line into the Federal Reserve's brain. If wage growth is running hot, say above 4%, the Fed starts sweating about inflation. If it's cooling off, below 3.5%, they can kind of relax. That sweet spot, the soft landing everyone talks about, is right there in the middle. The market's entire outlook on interest rates can turn on a dime based on this one data point.
Okay, so those are the big three from the monthly report. But if you really want to think like a pro, you've got to look beyond that one Friday morning and put everything into a much bigger context.
And that's where weekly jobless claims come into play. This data comes out every Thursday, and it gives us an almost real-time pulse on layoffs. The monthly report is looking in the rearview mirror. This is the canary in the coal mine for the job market.
And there are some really clear thresholds to keep an eye on. If claims are under 225,000 a week, that's a sign of a really strong market. But if we start consistently creeping above 300,000, that's a major red flag. And historically, anything over 400,000 has screamed recession.
So why does all this matter so much?
Because this data doesn't hit all stocks equally. Oh no. The jobs report triggers some very specific and very predictable rotations between different sectors in the market.
And the logic is actually pretty simple. When the job market's booming, sectors that depend on a strong economy, think consumer discretionary or financials, they tend to do great. But when jobs data is weak, the market starts betting that the Fed will have to cut interest rates. And that's when defensive, rate-sensitive sectors like utilities and real estate often take the lead.
So, now that you're armed with all this info, how do you actually use it without getting burned? Let's quickly go over a few of the most common mistakes that trip up investors every single month. First, do not treat that payrolls number like it's gospel. It has a huge margin of error. We're talking plus or minus 130,000 jobs. Second, be aware of weird statistical things like the birth-death model that can create phantom jobs. Third, remember the big picture. The overall level of employment is way more important than one little monthly wiggle. And finally, whatever you do, never, ever try to call a major new trend based on just one report. It's the 3 to 6 month average that really tells the story. So, I'll leave you with this final question to think about. Right now, the labor market is walking a very fine line. What do you think is going to be the first domino to fall? Will it be a sudden spike in those weekly claims, a jump in the unemployment rate, or a string of really ugly payroll reports?
You know, understanding data like this is absolutely crucial for navigating today's markets. For more data-driven insights, make sure you follow us here at pFinstill. You can also explore over 300 free learning concepts and even track all this data in real time on our live macro dashboards, all at pfinstill.com. Thanks for tuning in.